What are your thoughts on fees today?
The fees, as you know, in the alternative space are higher than what you see in the traditional space. And so this kind of response on fees or questions on fees comes from most institutions we speak to. I think in many cases you see a 2 and 20 quoted, as far as in the managed futures world with CTAs, as far as an average management fee and an incentive fee. And the bottom line is we always look at net performance. And when you look at all of those different factors, you can justify a higher fee structure.
What's your approach to building a portfolio?
We identify, the investment profile that the institution wants as far as the mandates they want. Most of them will migrate to our model portfolio, which is a globally diversified portfolio, globally diversified from three different aspects. One, that we want to employ multiple CTAs that allows us to employ all the markets available across the 6 sectors within the futures and currency arena. We also want diversification on time windows, meaning different CTA strategies that employ all the way from short-term, intermediate, long-term. Our model portfolio also employs different trading strategies, different trading styles, and there are a number of those that go well beyond trend following. We've evolved our CTA database over close to 30 years now. Part of it is proprietary, that being CTA programs that we've found and incorporated into our database that are not in commercial databases. We also supplement that database with a few different commercial CTA databases that we think are good. Both myself and our Director of Research are past CTAs, along with a staff that is skilled in other areas.
What are your thoughts about the makeup of the CTA space and this concentration of assets among just a few managed futures firms?
I think there's a misperception that the industry is a trend-based strategy, the managed futures industry, and as long as you have trend-based models in place, then you've got this investment strategy or asset class covered. Great diversity in the managed futures industry across different CTAs. They have different trading approaches, different trading styles, different levels of intellectual property, and so forth. With this manager concentration, if any one of these large CTAs has a mishap, and it has happened a number of times over the last 30 years, then a number of institutions that are employing this investment approach, investment strategy, by simply hiring a few of the largest CTAs, maybe would get the wrong impression of the managed futures industry.
What do you look for in CTAs?
Components of our investment approach is to employ what we call core CTAs as well as satellite CTAs. And as the name implies, core CTAs are those that are more globally diversified, many times larger in size, but that is mixed with a number of satellite CTAs that, again, as the name implies, may be smaller in size, more of a specialized approach, and things of that sort. So we want a blend of both.
Jack Schwager argues that the managed futures space has size constraints. What are your thoughts?
When you look at some of the other trading approaches, trading styles, whether it be pattern recognition or there's a number of mean reversion approaches, that's just a couple of examples. A number of those do have capacity limits, and so therefore those are identified early, within the process. We're familiar with all those strategies and are familiar with some of the limitations that exist, and therefore their amount of AUM would be expected to stay within certain ranges, certain bands, to where they can effectively manage those specialized approaches. In most cases, when individual CTAs get more AUM, it in most cases can become a disadvantage. As the industry is successful and grows, then that's going to affect individual CTAs. So there are limitations. It's almost impossible, I think, to empirically identify those. But for those of us that have been in the industry for decades, we've seen the different performance cycles. We've seen the effect of growth, new AUM, things like that. We can see how it can negatively affect the industry as a whole at times. I think they're short-lived, but it can occur. I would probably defend the industry from the standpoint that I would argue that CTAs, when you look at the sophistication of CTAs, their risk management techniques, their trading approaches, the development of their models, the research staffs that they have, I would argue that there's very few, if any, other investment approaches that are sophisticated as CTAs. So when these challenges come about, I guess we have confidence that the CTAs are able to identify some of these challenges, and they do occur with substantial growth, but they're able to identify, change some of their models, things of that sort.